This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Ryan Kelley, who's the Chief Investment Officer at Hennessy Funds. Let's jump right in. Ryan, we're recording this in December of 2024. We've had 2+ years of over 20% returns in the S&P 500. How should investors be thinking about the markets in 2025?
Sure. Well, it's great to be here with you again, Jay. We look back through history. This is actually only the fourth time that this has happened for the S&P 500. So it's really hard to draw any conclusions from such a small sample size. However, when we look back at the last 100 years for the Dow, this has happened 9 different times. But unfortunately, there really is no strong correlation that would help us to predict what happens in the third year after 2 consecutive 20% plus years over time. We do find that in these 9 instances, there's a median return of about 2% in the third year, but the range is pretty great. In 1937, for instance, the Dow dropped 33% in that third year. But in 1997, more recently, the Dow rose 25% in that third year. So again, there is no real prediction we can make. But it is interesting to see where we have been in the past. What I think investors should be more mindful of is the fact that with such great years in 23 and 24, we are at fundamentally a different place today than we were 2 years ago. PEs have gone up for the overall market, yet corporate profits and economic outlook have not really increased in lockstep with the PEs. With the S&P 500 at 23 times next year's estimates, or 2025 estimates, I should say, and expected earnings growth of about 12%, investors are really expecting a lot to go right in 2025. Our chief market strategist, Neil Hennessy, he's looking for somewhat more muted returns in 2025, with the midpoint of his Dow price target at about 45,500, which is only about 4 or 5% upside from here. But putting this all together, we think that the potential upside in the overall market at this time is less than it was a few years ago, and that expectations are somewhat stretched.
Right. When you look back on 2024, what drove the strong performance in the S&P 500?
Sure. Well, I think overall the primary driver of this performance in 24 was the resumption of Federal Reserve interest rate cuts in September. Overall, many broad-based economic metrics looked pretty good. Stock-specific fundamentals were incrementally positive for the year. But really, what drove the Fed's decision to start reducing rates was the fact that inflation dropped down from the 5 to 6% level in the year prior to a more palatable 2.5 to 3% level in 2024, as measured by the CPI. We saw some significant outperformance by certain sectors that we haven't seen for quite some time, namely utilities and financials. Financials did exceptionally well compared to the overall market, and this is, in our opinion, long overdue. And utilities, while normally defensive in nature, also had an excellent year as investors began to focus more on their long-term fundamentals, the fact that they've been lagging for many years, and their relatively low valuation when compared to the overall market. On top of that, utilities' dividend yields become more attractive when rates are falling, and that's what we ended up seeing last year. It was encouraging to see that these returns came in these particular sectors simply because they are not sectors that are dominated by the mega cap companies such as the Magnificent Seven.
Yeah, I tell you, one of the most interesting dynamics of 2024 has been the extreme index over-concentration with that Mag 7 driving so much of the performance attribution in large cap indexes. How should investors look at this as we head into 2025?
Sure. I mean, that's a great point. We'll talk a little bit more in depth about 2025, but let's take a look at where we really have been and how dominant the Mag 7 has been and currently is. In 2023, close to 72% of the S&P 500 performance came from just 7 stocks. In 2024, we saw a little bit more of a broad-based rally in the S&P, but still about half of the performance came from the Mag 7, which also means, on the flip side, that about half came from those other 493 companies, which is pretty incredible when you think about what's actually happening out there. That performance, again, some of the other good performance were from certain sectors outside of tech and outside of communication services, such as utilities and financials. We also saw some pretty good performance in small and mid-cap stocks as well, not just these mega caps. And we would think that with the Mag 7 valuations being pushed pretty high, that 2025, we could see better performance from all the rest, including from certainly some of those small and mid-cap stocks. We actually have two funds that are concentrated in this space. We have the Hennessy Midcap 30 Fund and the Hennessy Cornerstone Growth Fund. They're both focused on small and mid caps, and both have certainly found over time some good investments in these stocks, even when the overall market is being dominated by the Magnificent Seven.
Ryan, how have investors' expectations changed since the elections in November?
Sure. Well, on the positive side, I'd say first and foremost, the fact that we got the results so quickly certainly sent the markets higher. Also, in the new administration, there is certainly an expectation that the environment will improve with potentially less strict regulations in certain industries, namely financials and energy and utilities, and certainly a reduction in the corporate tax rate could absolutely be beneficial for stocks as well. We've seen that in the past, and if they do that again this time, that should be beneficial overall for profitability at these companies. Additionally, we may also see the administration try to reduce the individual tax burden, not just corporate, and that, of course, would be positive overall as well for the economy. On the negative side, however, I would say that there's a few things going on. We see increased geopolitical tensions that are surfacing. And certainly in this administration, the risk of the unknown is probably going to continue to increase. And in general, the stock market doesn't really like the unknown, and that can create more volatility. But most importantly, the effects of increased tariffs and potentially deportations could absolutely be detrimental to the US consumer and to many different companies and sectors within our economy. If tariffs are increased substantially, and if we do see significant deportations, we could see some real issues with costs. We could see some labor shortage issues in certain industries. And ultimately, we could definitely see some supply chain issues. And that's potentially, I think, the biggest issue with increased tariffs is that it does affect the supply chain overall. So again, there are going to be a lot of changes, some positive, potentially some negative, but we'll just have to wait and see what actually gets implemented.
When we look at investing in small and mid-cap companies versus large-cap companies, does the size premium still exist?
That's a good question. So the size premium is technically the additional premium or a higher expected return that investors have when buying smaller companies. Smaller companies tend to be more risky, show more volatility, and therefore have greater overall risk. So investors expect that they will have greater returns and greater rewards for taking on that greater risk. However, it's actually been quite a long time since small and mid caps have outperformed large caps. And the last time this actually happened was in 2016. What's going on right now, though, is, to drill down a little bit more, is I think that there's also big differences in these indexes and these market cap sizes when you take a look from a higher point of view. Large caps and small caps have different compositions and different drivers. Small caps tend to be more domestically focused. They're more sensitive to higher US corporate tax rates. And on the flip side, if we see corporate tax rates declining, that should be beneficial for them. Mid caps tend to have broader business models with less concentration risk than small caps. Yet they're still small enough to grow substantially within their industries over time. And finally, when you look at the indexes themselves, large caps are dominated by tech, with the S&P being about 32% technology companies. And they're also heavily concentrated in the largest names. So the Mag 7 makes up a third of the S&P 500 in market cap and almost half of the NASDAQ. So that's just a substantial concentration in just a few stocks. On the other hand, small and mid-cap stocks are much more diversified across different sectors. They're less concentrated in individual companies. And we think that that could be beneficial going into 2025. With only 12% exposure to technology in the small and mid-cap space and more concentration in financials, consumer discretionary, and industrials, we think that if we're in an environment now where maybe these large mega caps aren't moving quite as much and the rest rises, that could be very beneficial for small and mid caps going into the rest of 2025.
So, Ryan, energy has been the worst performing sector for the past 2 years. How should investors look at the energy space as we head into 2025?
Energy goes in cycles, obviously very much tied to commodity prices and a lot of times to other opportunities in the market. But overall, we think that energy has nice long-term attributes and that simply put, energy is now a growth industry for the next few decades. Global population growth, the pursuit of improved standards of living, they're all driving needs for expanding volumes of all forms of energy. Certainly growth in AI and data centers, that puts a lot of demand and extra demand on energy in particular. And the onshoring of manufacturing, that should also continue to prop up domestic demand as well. Additionally, when we look at the transition to cleaner forms of energy, that's driving investment opportunities within the space, both for traditional energy companies and for renewable energy companies. And this certainly is creating opportunity for investors as well. And finally, when you look at the way that management teams are running their energy companies, they're much more in line with shareholder returns and shareholders than any time in the past, in our opinion. So that's very good for the stocks as well. So when we look into 2025 and considering what's happened for the last 2 years, we think that valuations are attractive and they don't really sort of give enough credit to the fact that these are now going to be pretty growth-oriented companies, and they certainly have more shareholder-friendly capital allocation processes.
So, Ryan, with the financial sector having had such a great 2024, what's next for the financial sector?
Well, we think actually that there's still more to go, that 2025 could be another strong year for financials. Certainly, we have 2 financial funds that are positioned in this way. We have the Hennessy Large Cap Financial Fund and the Hennessy Small Cap Financial Fund, and they're both lead managed by Dave Ellison, who's been working in this space since the mid-'80s, way back at Fidelity, working with Peter Lynch. So he's got a lot of experience in going through different cycles of financials. We think that the 3 main factors that will continue to benefit financials in 25 would be continued rate cuts, a reduction in the short-term rates, which will then cause a more normalized, potentially steeper yield curve, and incremental loan growth, which we haven't seen for a few years. In addition, as we see any relaxation of regulations, that could be constructive for the industry as well after many decades of pretty strict regulations overall. And financials right now are in good shape. Their balance sheets are strong. Their loan losses and asset quality are all very good, certainly within long-term normal ranges, and profitability is improving. So these are all potentially good attributes that should continue into next year. So overall, we think that based on the fundamentals of the companies themselves, an improving interest rate environment, there's a potential for PE expansion, and increased M&A could potentially kick in as well, which is also beneficial for this industry.
So the international markets have struggled versus the U.S. markets recently, but not all international markets are the same. Given Hennessy Funds has 2 Japan-focused funds, what are your thoughts on investing in Japan today?
Sure. Well, we've certainly had a lot more investors asking about investing outside of the United States. And just as an aside, I think that's probably related to the fact that we've seen so many years, 15, 16 plus years of just incredible returns in the US markets that, people are asking, where else should I go? Where else is there opportunity? And I think that's a good point. And that's something certainly to ask. We have those two funds you mentioned. We have the Hennessy Japan Fund and the Hennessy Japan Small Cap Fund. These are both solely invested in Japanese equities, and they're both managed by expert portfolio managers from our sub-advisor called Sparks Asset Management, which is actually headquartered in Japan. And so they really understand the Japanese economy and the Japanese market very well. So the Japanese equity markets have always had and included very high quality companies. But now we think that and this is also our thoughts from the portfolio managers at Sparks, that there's certain macro factors that have made them even more bullish when it comes to Japanese markets. Government initiatives have encouraged companies to become more shareholder friendly. For example, the Tokyo Stock Exchange has actually introduced an initiative to drive better governance. It's focusing on having the companies focus on their returns and on shareholders. And if you're a stock that's trading below 1x price to book, you're actually in the spotlight. They want you to be more shareholder friendly when it comes to the management teams. We're seeing inflation and wage growth starting to come up in Japan, and that's actually a good thing, as we've had many years of deflation in Japan. And certainly wage growth this year in 2024 was over 5%, and that's very beneficial for overall Japanese consumerism. And lastly, Japanese investors themselves are also putting more into the stock market. Most household financial assets are actually sitting at banks in Japan earning little to no interest. But now the banks are starting to push and have new initiatives for them to open brokerage accounts and be able to invest more easily into their own stock market. So we put all these reasons together, and we think that Japan certainly shows some compelling opportunity.
Ryan, would you give us a brief summary of your thoughts on 2025 and wrap up with your lens on how Hennessy Funds is differentiated in the crowded asset management space?
Sure. So again, to sort of recap briefly what we've talked about already, we think that this year we'll probably see some increased volatility and overall somewhat more muted returns in the broader market. Again, our chief market strategist is only looking at the midpoint for about 4 to 5% upside from here. We see continued opportunity in certain sectors, such as those that have done well in the past year, like financials, but also some sectors that have not done so well, such as energy. Small and mid-cap stocks may perform better this year, given that their larger counterparts have been stretched on a PE basis, and also given that these small and mid-cap indexes, at least, are a little bit more diversified across different sectors throughout the economy. And, the potential for rate cuts, less regulation, and a lower corporate tax rate could certainly be beneficial and almost disproportionately beneficial for the small caps, the mid caps, the financials, and a lot of domestically focused equities. But no matter what our outlook, here at Hennessy, our point of view is to stay invested, to diversify with quality, and to invest over the long term. We offer, high conviction portfolios, time-tested investment approaches, and long-tenured management teams, whether they're internal management teams or even some of our sub-advised funds that are managed outside of Hennessy. We always try to invest with optimism, but we're mindful of downside risk. We'd much rather make a little less money for our shareholders in up markets than lose more money in down. And lastly, I'd say that we offer a pretty compelling partnership for our investors. We have direct contact with our portfolio managers, and we provide pretty good investor education materials that are above and beyond what other firms of our size typically offer.
Well, Ryan, congratulations to you and the rest of the portfolio management team on a very successful 2024. Viewers, to learn more about Hennessy Funds, please visit hennessyfunds.com.